This is a discussion. While I try to get into some details on some of these items, an hour is not enough time to go over all the topics. So this is kind of for discussion purposes only. This is not legal or tax advice. If you have anything specific, you can reach out to us individually after, and we can try to address very specific, detailed questions. This is our agenda. There are some items that are not on this on bullet points here that were added in somewhat last minute. Some new information that came out in the past week or so. But we will try to cover a lot of information in the short time. All very important information to get you through a successful 2024 and changes that go into effect in the next couple of weeks here. If you are not a PayMaster client, most of this is non-PayMaster client related, but if you are, these are our holiday hours and schedules for the coming weeks. We are closed Christmas Day and New Year's Day. The banks are closed, so no transactions. So if your check date happens to be on Wednesday, you want to make sure you communicate with your payroll specialist to move that to either the Tuesday before or Thursday after. One day we will be closing early. That is Christmas Eve. We will close at 2 p.m. on Tuesday, December 24th. So please take that into consideration when you are submitting your payrolls. We suspect that's probably going to be a very busy week, Monday and Tuesday, as kind of Christmas falls right in the middle of the week there. All right, so let's jump into the fun stuff, taxes. State unemployment. As we go through December and even into January, you may receive lots of tax notices from the state and the IRS. Please forward those to us. Sometimes it may not seem like anything important. I would rather you forward into your payroll specialist anything you receive, and we can look at it and determine if it's important or not. Some states do provide the payroll service, in this case, PayMaster, do provide us with rates, but many do not. They provide the rates to the taxpayer, which is you, and we rely on you to forward that to us. So again, please send us that information so we can make sure that we update any rate changes into the new year. This is a slide from, I believe, early 2020 or maybe late 2023. These are, and you don't have to sit there and look at each state at the bottom, but each column or bar on here represents a different state and the amount of funds the state has in their unemployment pool. It's their trust fund balance. So when an employee is separated, they go to collect unemployment. This is how much money the state has. 100,000. So is it on the left? Oregon there has about $5 billion in their pool. They're prepared for a huge disaster of some sort in Oregon. And on the far right, we have California, which they are in the negative by roughly $18 billion. In the negative. What this means is, some of these states need to bring up their trust fund balances, and they can do that in two ways. They can increase your unemployment rate, in which case it's obvious. You see your rate go from 2% to 3%. You're seeing that. I don't know if this is kind of sneaky how some states do it. But rather than changing the rate, some states change the base of wages you pay that unemployment tax rate on. So, for example, if you were in Delaware here, your rate may remain the same. You may see your unemployment rate is 2%, but in essence, you're going to pay 20% more in unemployment taxes on wages in that state because they up their wage base. One state here for this coming year has lowered their wage base. They actually dropped it $500. So employers in that state will pay a little bit less of an unemployment tax, even though their rate may remain the same. Federal unemployment, on the other hand, the federal government dictates that rate as 6%. And they then provide a 90% discount. So don't say the IRS, the government doesn't give you a discount. Here they're giving you a 90% discount if you pay unemployment taxes to a state fund. So what that translates to is instead of paying 6%, many employers only pay 0.6%, with one exception. And that is for those states that went into the negative, so they don't have enough money in their state to pay unemployment claims, they borrow money from the federal pool, right? Nobody collects unemployment from the federal government. You collect from the state. So this 0.6 of a tax you pay to the federal government goes into a pool, and they use it to loan money to the individual states. That loan is good for 2 years. If the state does not pay the federal government back within 2 years, there's a penalty to employers in that state, which we're going to talk about in a moment here. I kind of have one slide in between this. The dashed line is where the federal government says states should be as far as how much money they have in their pool. So at the top, there's Wyoming. They've got more than the federal suggested amount. The ones in the red are below the Fed. We can see down here at the bottom, there's quite a few that have no money. This is from 2022. I left that up there from my presentation a couple of years ago, so we can see now 2024. States are getting a little healthier with their unemployment pool, except there's just a few states at the bottom here: Connecticut, New York, California, and the Virgin Islands. For these states, they have an outstanding loan from the federal government. I have 2020 in the middle, so it's this is 2020, 2023 balance, and this is 2024 on the right. We can see California, they paid out a lot of unemployment claims in the COVID year, and they owed $23 billion. They paid a little bit back in 2022, but it looks like they kind of went the other way. They had to borrow more money in 2023, 2024. Illinois paid off their balance that they owed to the state, and kind of at the last minute, just last month, the state of Connecticut paid off the 60 million or so balance they owed to the federal government. So what that leaves us with is California and New York, and the Virgin Islands, and they've been on this list since back in the 2009 crash. So if you have employees in California and New York, you are in essence paying a penalty rate on your federal unemployment tax, because those two states and the Virgin Islands still has an outstanding loan. The federal government is now coming after the businesses in those states and making them pay back the loan. So as we said a moment ago, the unemployment tax rate is 0.6%. But if you're in California, New York, you're going to pay 2.5 times that. You're going to pay this 0.6, and now you're going to pay an additional 0.9%. This was just published a couple of weeks ago. As your payroll service, if you're with PayMaster, we are going to calculate this credit reduction, this additional tax, and we will be collecting it in early January to get this additional amount of tax paid before the deadline of the end of January. So we will be doing that automatically in filing for this credit reduction. Secure Act 2.0. This is a law that was passed back in 2022. And in it, there were provisions for changes in each year. I think going into I know there's 2025 changes that are in this act. Today, we're talking about what's going to affect us in the next 2 weeks. There is now what's called a super catch-up. If we should all be familiar with the regular catch-up, which states if you have an employee who's 50 and over, they can contribute an additional $7,500 into their 401k plan or 403b or into their retirement plan. What goes into effect January 1st is if the employee is aged 60 to 63, by the end of that year, they're eligible to contribute 150% of the regular catch-up. So for 2025, the catch-up for those 50 and over remains 7,500, so times 150%. It's $11,250. Employees who are 60 to 63 can contribute. I don't know about other payroll systems. I know if you are with PayMaster and you have your 401k in our system will mandate date of birth. We will automatically look at that employee's age and allow them to meet this super catch-up of an additional $11,250 on top of the regular catch-up. I think this is going to cause some headaches, not necessarily in our payroll system, but there's this new term. Well, I say new, it's been around, the parameters were a little different, but this term called the long-term part-time employees. They will now be eligible to participate in your plan if they worked as little as 500 hours or greater than 500 hours in 2 consecutive 12-month periods. So this is really something your plan administrator, your 401k should be monitoring. If they're being sent the hours, they should be identifying who's eligible. But this is the tricky part. It's optional whether you allow those employees to participate in the match. So, while the government is saying they need to participate in the plan, it doesn't have to cost the employer anything if you don't want it to. You can say long-term part-time employees, we're not going to match on. What that means in our payroll system is the default is to match on all employees that are participating. So if you are going to do this, that's going to require notifying your payroll specialist, where we're going to have to create a new retirement plan profile that does not have a matching to it, and that needs to be assigned to these employees who you do not want to have a match on. So I have a feeling that's going to catch quite a few people out there. And the last thing, mandatory automatic enrollment. Plans created after 2022 are now mandated to have automatic enrollment. As the employer, you set what percentage they automatically enroll at. It must increase by 1% each year, up to 10 to 15%. This is, not necessarily a PayMaster concern. This is something you need to adopt into your 401k plan, whoever your 401k plan is with. There are some exceptions to mandatory enrollment, and I threw them in here. So if you're a very small employer, you don't have to participate in automatic. If you're an older plan before 2022, you don't have to do automatic enrollment yet. I do believe this is in the future. Eventually, we're all going to be affected by this. So there are some plans there where there's exceptions to this. All right, something I talk about every year, just because I continue to see a lot of it. I see companies affected by it, and that is direct deposit diversion fraud. Nope, I did have one question in here. Let me jump back to that. What if the 401k plan was switched between 401k companies in 2022, existed prior to 2022? So you change plan administrators or 401k companies, that would be considered a plan in existence prior to December 29, 2022. So that you do not need to have automatic enrollment yet. I do suspect if you are required, hopefully your 401k plan should be reaching out to you to say you need to implement this. But I don't know if they all do that. So direct deposit diversion fraud. I hate these companies, Green Dot, American Express, Chime. I wish they'd all just go away. They make payroll administrator lives miserable because of how easy they allow, or not allow, how easy they facilitate fraud. You can walk into most stores, 7-Elevens, Walmarts. You can look for these cards. It costs you about $5. Actually, it looks like American Express. You can buy one for $1.95. And in essence, you just bought a bank account. When you open that up, inside is a routing and account number. And registering the card is easy. That's my problem with these companies, is how easy they allow people to register and activate that routing and account number. What the criminal does is they now look to take that routing and account number and stick it places, namely payroll. So what they're going to do is they're going to impersonate an employee, and here's, this is me. And Pam Hunt is an employee that hasn't worked with us for many years, which is my first giveaway. Is I'm getting an email from an employee that's gone, but this just came in less than 2 weeks ago, 11 days ago, and the email goes something like this: it's, hey, my direct deposit information has changed. Can you change my account? We can see that we can kind of see this is not from Pam's email, or I know this is not Pam's email. Whoever this criminal is, and maybe my email has been sold out there, but this one came in June 24th. We can see the email is a little bit different. I got this one May 31st, from a different email. But the intention is same. Someone is impersonating an employee, trying to get me to change the direct deposit account for that individual. I have seen some creative ones where they will create a Gmail account that, maybe it's Pam Hunt 1942 or something like that. And I may look at the email and say, oh, all right, the email is from Pam Hunt. So it's very easy for someone to create an email that looks like it's from the employee. We've also seen cases where a criminal or fraudster gets into an employee's email. So the email is actually coming from that employee's real email address. So the best practice here, and if you don't listen to anything else I have in the webinar here today, is as a payroll administrator, if you receive a electronic communication, whether it's email, I don't know if anybody gets faxes anymore, or text message, but if you get any sort of electronic communication from an employee to change their direct deposit account, do not do it. You want to hopefully, ideally, have a face-to-face conversation with the employee. All right, so I got this from Pam Hunt. Let's say she was an active employee. If you're in an office, go to Pam. Hey, did you just send me that email to update your direct deposit? Pam says yes. Great. Update it. You can do a phone verification. So if you're not in the same state or the same office, have a phone verification where you are calling the employee. I just suspect as AI grows and that this type of fraud is just going to continue to look like it's coming from the person. So, so please verify all direct deposit changes you do. And if someone does send you direct deposit information, if you send me the account number that was used to attempt to commit the fraud, I do have contacts at 2 of 3. I don't have a contact at Chime yet, but I do have contacts at American Express and Green Dot where I can get that account shut down. So hopefully somebody else doesn't fall victim. 2 other quick things here before my next 5 minutes is over. ERC update. I know there's still companies waiting for ERC. The IRS did practically shut down processing for about 10 or 11 months. Since August of this year, so just about 4 months ago, they're processing over 100,000 claims a month. They're getting through these. They are finding legitimate claims and identifying them as suspicious, so they are sending out letters of rejection. Those letters do need to be responded to in 30 days. If you don't, you have to file a lawsuit against the IRS, which I don't know what's involved in that, but I know it's going to be time consuming and probably costly. So if you do get a rejection and you have a legitimate claim, or if PayMaster handled your ERC filing for you, please forward it to us. Anything that we prepared, we stand behind and will respond to the IRS accordingly. If you haven't filed, technically it's not too late. You have until April 2025 to file a claim for the 2021 year. The IRS is still receiving claims, and they will still process them. You're going to be at the bottom of a very deep pile of unprocessed, but it is still open at this time. All right, two recent changes that just came about. If you've seen our newsletters or seen the news, there was a new reporting requirement called beneficial ownership interest reporting, or BOI reporting. It is a Department of Treasury action to help fight financial crimes, money laundering, criminal activity, and what the government is looking for is who are the owners and managers of companies. It's a fairly quick reporting. It is now a little tricky if you're doing it for the first time. It may take you an hour or so to get through. This started early this year. A group in Texas filed that it was unconstitutional. You were still required to file until just December 3rd, and the U.S. District Court in Texas put an injunction against the enforcement of it. So what this means is the government can't come after you if you don't file with any penalties just yet. And the penalties are, I believe, $500 a day, $10,000 maximum for not filing. 36, I think it's like 36 million businesses are required to file. They last reported only about 9 million had filed, and the deadline is the end of this month. The government has appealed that decision. So we don't know where this is going to go. As we know, there's going to be a presidential change in a few weeks here. I really don't know what that means, if the government will continue to fight this or will throw in the towel and not require it anymore. So if you filed already, great. If you haven't, you can if you want. The filing portal is still open. PayMaster can file this for you. We do have some companies that are still continuing to file in the event this comes back. I do suspect if the appeal wins, and this does come back sometime after December 31st, that they'll provide a grace period to get people to file. So there may be a mad rush to get this done. The second thing that just came about earlier this year, it was passed to increase the minimum wage for exempt employees, the minimum salary for exempt employees. November 15th, again, Texas, they invalidated that increase, and they invalidated it retroactively. So if you the increase was two parts, and my apologies, I don't have the amounts of the increase, but you were supposed to have put in an increase on July 1st, and there was supposed to be another increase that came January 1st of 2025. So November 15th, they retroactively did away with this. So you probably increased employee salaries as you were supposed to in July. You can't retroactively take money back. You can reduce someone's salary at this point going forward. I mean, that has morale issues and other concerns like that. Downgrading someone's salary, but you do not have to increase the January increase that was supposed to come up. So, all right, I didn't see any other questions pop up. Again, I'll be back at the end. So I will now turn this over to Kate.
Thank you.
Yeah,
go ahead and share mine.
All yours.
All right. So I see a lot of familiar names out there from people that I've spoken with. For those of you that I have not spoken with, I am the payroll manager here at PayMaster. So I am going to talk about some payroll specific things. One thing I did want to piggyback on what Romeo was saying with the direct deposit diversion fraud. That is the reason why sometimes your payroll specialists may call you to verify those direct deposits or send you an email that they're trying to, verify that direct deposit with you, and why you might sometimes see delays in there. It's just an extra layer of protection for your employees to try to catch those before they happen. On to the topics that I wanted to cover today. The first is taxable fringe benefits. It is that time of year where we need to get those in so that they can be reported on W-2s. If you have questions about what is taxable, what is not, the IRS does have a publication for that. It is IRS Publication 15B. Unless a fringe is specifically excluded, it is in fact taxable and needs to be reported for your employee. Some of those exclusions are discounts provided to your employees, a cell phone that is provided to your employees, group term life insurance up to a $50,000 coverage level, health benefits, dependent care assistance, on-premises meals, or things that are so minimal in value that it wouldn't be practical to report them. Things that are included: gift cards, gift certificates, anything that has a cash equivalent, personal use of a company vehicle, group term life insurance that is over $50,000 would also be taxable to the employee. 2% shareholder insurance is a fringe benefit for businesses whose owners have a share of 2% or greater, and the business pays for their health insurance. This would include health insurance, vision insurance, dental insurance, HSA contributions, any of those Section 125 benefits. If the company is paying for them, they need to be reported as taxable income as well. If you are paying your employees supplemental wages, and these could be commissions, bonuses, vacation payouts, PTO payouts, anything that's above and beyond their normal wage, there might be some additional tax considerations that you need to think about. There's 3 different options when you are looking at that. You can withhold a flat 22%, which is the IRS's recommendation for those wages. You could tack them on to an employee's regular check and allow the system to calculate the taxes based on what the employee has claimed on their W-4. Or you can withhold a flat 37% if that supplemental wage has a value of greater than $1 million. Some examples of the different ways you could break those out. There is a calculator function on PayMaster's website that you can use to kind of play out the different scenarios. But in this example, they have a regular wage of $1,000, and then they're receiving a $500 bonus. If we were to break that out into 2 separate checks, and you take a look at that federal tax, that is what it would look like if they were separate. But then if you combine them onto one check, you could see it withholds less tax than if they had been broken out and taxed at that supplemental rate. If you have questions, like I said, there is that calculator function on PayMaster's website. You can play around with the numbers, the different types of taxation, to see what that best end result would be with that. There are some upcoming deadlines that we need to kind of keep in the back of our minds. W-2s and 1099s must be distributed to your employees by January 31st. That tends to be the same year to year to year. If you're mailing them, they do need to be postmarked by that day. They need to be filed with the Social Security Administration and the IRS by January 31st. as well. We will start processing W-2s here at PayMaster as soon as you run your final scheduled payroll of 2024. If you have anything special, make sure to let us know so that we can kind of put your account on hold so that those W-2s don't get processed until we have that change in place. Those things would be those fringe benefits, if you have third-party sick pay, if you're going to have a last-minute bonus payroll, anything like that, make sure to let your payroll specialist know so that your W-2s don't get processed prior to that being done. The W-2 itself, employees can opt to receive it electronically within PayMaster HCM. That is a function within the system itself. They have to be the ones to go in and elect that. Once they elect it, they can at any time take that authorization away and go back to receiving a paper W-2. If they have opted into the electronic one, nothing will print for them. So if you have, 500 W-2s that were actually issued, but you receive only 250 paper ones, take a look at who electronically opted in and who didn't. If an employee is terminated, that authorization for an electronic W-2 automatically gets revoked and they will get a paper W-2. There aren't any changes to the W-2 this year. There is a guide on the PayMaster blog. Romeo actually just reposted it again the other day, so it's right there at the top if you need to read the breakdown of the different boxes on the W-2, how to read them, what the different boxes mean. It's also good to have on hand when your employees have questions, and they will. Even something as simple as, why do the gross wages on my last paycheck not match the wages in box 1? That's because box 1 is not gross wages, it's your federal taxable wages. But Romeo's blog post goes through all of that. The Social Security number verification, if you opted in, you should have your results posted in PayMaster HCM at this point. They would be in company documents. Any Social Security number, just so you know offhand, that starts with a 9 is not valid for work authorization. That number will also not be accepted by the Social Security Administration and IRS when we go to file your W-2s at the end of the year. So make sure you are not sending over paperwork for employees that have a Social Security number that starts with a 9. You're not entering employees with a Social Security number that starts with a 9. If you have not yet had us do your Social Security number verification, it is something that we offer every year. We send all the Social Security numbers to the Social Security Administration, and we get the results back as to whether or not it's actually a valid Social Security number. The IRS does assess penalties for filing with an invalid one. So doing the verification kind of heads that off. It is also something, if you don't want PayMaster to do it for you, you are able to do that yourself on the Social Security Administration's website at any time. You just need an account with them. For 1099s, in the last couple of years, we have seen those broken out into 2 separate forms. There's the 1099 miscellaneous, which has been around for years and years. And I believe it was 2020, the IRS introduced the 1099 NEC. NEC is non-employee compensation. By default, any 1099 wages that you report to PayMaster are going to be reported as that non-employee compensation unless you tell us otherwise. The things that go on a 1099 miscellaneous would be things like rents, royalties, attorney fees, prizes, awards, those types of things. If it is a person performing a function for you and you are compensating them for that, that would be that 1099 NEC. ACA, you over the last couple of months have been getting email reminders about getting the ACA completed so that we can generate your 1095s. Something important to note, that if you are ACA mandated, that does not mean every single employee in your company is going to get a 1095C.
Yeah.
Only those people that have been full-time for at least a month and were required to have been offered coverage under the ACA are required to get that 1095 form. There are a couple different versions of that 1095. Most employees will receive a 1095C, but there is also a 1095B form. Those will go out to self-insured and level funded employers, which level funded is actually new, and Romeo wanted a few minutes to kind of go into what that is.
I guess not so much what it is, but just that it exists. And what level, well, we kind of know what fully insured is. You pay the insurance company an amount of money, and then they cover your employees. Insurance. You don't pay any more, you don't pay any less. Self-insured is kind of the other end of that, where you still have an insurance company, so it still could be with United Healthcare or Florida Blue or whoever. But self-funded is a little bit different. The employer is funding the insurance. Sometimes I hear you get insurance to cover that, so you have some maximum liability. Level funded is like an in-between, and there are some benefits to the employer or the employees. The insurance can kind of fluctuate. You can get money back. It's kind of a new plan. And what I have found is when your agent sells you this plan to implement, they say, oh, it's a level funded plan. You may have a lesser premium to pay, which is why you probably want to implement it. But what the agent and your carrier typically fails to tell you is you are now ACA mandated. You now have to file ACA forms, no matter how small your company is. So while typically you only have to give 1095 forms out if you had more than 50 full-time equivalent employees in the previous year, you're an applicable large employer. If you're level funded plan, you could have 10 employees and you now have to file these 1095 forms. So last year, we had some companies identify this into 2024, that their plan was level funded for 2023. So you want to confirm if this applies to you like now, because there is a lot of work to get up to speed with ACA, especially if you have not done anything for 2023 and you're a small employer. So all right, that was my 30 seconds. Is that what I said? I gave myself.
Yep.
All right.
Yep. All right. So thank you. The limits that will be changing for 2025, the wage base for Social Security will be increasing to $176,100. The 401k maximum contribution is going to $23,500. The catch-up will be $7,500, with that super catch-up that Romeo was talking about earlier, being $11,250 for those employees that are between 60 and 63. Simple IRA will be limited to $16,500 with a catch-up of $3,500. IRA contributions, $7,000. HSAs will be increasing. Does it include 457 plans, Romeo?
I will find out. I don't know the answer just yet, but I'm
All
going to look
right.
that up right now.
Okay. HSA contributions, $4,300 for single, $8,550 for family. The catch-up for those is still $1,000. FSA contribution limit will be $3,300. The QSERHA is $6,350 for single, $12,800 for family.
I do have an answer. Yes, 457 plans do have this new super catch up. So, yep.
Perfect. Thank you. Minimum wage changes. 27 different states have increased their minimum wage for 2025, most of which are for January 1st. There is a blog post that was posted in the last couple of weeks that outlines all of those. There are more and more counties and municipalities implementing their own minimum wages. For example, Burien, Washington will have a minimum wage of $21.16 starting in 2025. As many of those as we could possibly identify are listed in that blog post. However, because there are so many of them now, we cannot possibly, cover all of them. So there are also links to where you can look for that information if yours is not listed. There are still 20 states that utilize the federal minimum wage of $7.25 an hour. Those are all listed there as well. Alabama, Georgia, Idaho, Indiana, Iowa, Kansas, Kentucky, Louisiana, Mississippi, New Hampshire, North Carolina, North Dakota, Oklahoma, Pennsylvania, South Carolina, Tennessee, Texas, Utah, Wisconsin, and Wyoming. The W-4, this comes up every single year, December into January, as people are getting their W-2s, starting to file their taxes. We didn't withhold enough. We didn't withhold anything throughout the year. In 2020, the IRS did release a new W-4 that has kind of a new or a completely different basis to it than the old one did. It is much more specific and much more accurate. The end goal is to actually have that employee's withholding be as close to their actual tax liability as possible. So where employees may have always gotten large refunds, they may not be seeing those refunds now. It doesn't necessarily mean that the withholding itself was incorrect. It just means that their withholding changed based, what they're claiming on their W-4, and it aligns a little differently than it did in the past. New employees do need to fill out that W-4. If they do not, you should be putting them in as single with no kind of deductions claimed. If they claim exempt on their W-4, they do need to fill out a new one each year in order to maintain that. The PayMaster system does not change that if they don't. So that is something that you would need to kind of maintain on your end. The IRS does have a great tool on their website. I send this to clients anytime they have a question. It is irs.gov/W4app. It is a withholding estimator. The employee can put in all of the information that pertains to them, and it will tell them what exactly they need to put on their W-4 to have the end result that they want. And they can even specify, what they want to get back when they file their tax return at the end of the year, or if they want to just, have it be a wash. The system or that estimator will tell them how exactly to fill out that W-4. And I believe they can even print that out as well and give it to you. There is also on PayMaster's YouTube channel, Romeo posted a video on there kind of explaining how to fill out that W-4. It is aimed at employees, so that is something that you could provide to them as well. The most common error made on the W-4 when people are filling it out is disregarding this little checkbox here. This checkbox is for multiple jobs. If you're single and you work more than one job, you should have that checked. If you are married and filing as married, and your spouse has a job, that box should be checked. And that is where it gets missed a lot, and that is going to impact your withholding, and you're quite possibly going to find yourself owing money at the end of the year because that should have been checked and was not. And that was everything I wanted to go over. Did anyone else have questions? No?
Jamie, you can either put it in the chat, or if you want to come off of mute, welcome to do either. Let's see, questions.
Right, and Danielle has one too. Any word on when the new W-4s will be released? Typically end of December, beginning of January, but I don't believe there's any changes coming on the 2025 form.
Yeah, still 2024 out there. And you can still continue to use the form. Employees don't need to complete a new form. And I think you cover this, Kate, unless
Yes, unless they're making changes.
unless they're making changes, or I believe if someone said they were exempt, I believe they have to submit a form
The new one.
each year.
But that actually brings up something that I did not cover in my slide about the W-4. If you have employees that are on that old previous version of the W-4, where it asks for the number of exemptions, they can stay on that. They're not required to switch to the new one unless they make changes to their withholding. They are grandfathered in on that old one until they want to change their withholding. So anything pretty much from this point that is being turned into you should be the new W-4. But if they're on the old, they can stay on the old.
Yeah. And there's
no, go ahead.
I was gonna say that the question about being a consultant, multiple jobs. So that you want to go, okay, you want to go back to the W-4 screenshot there. Yep.
That
one. So this this section, as Kate said, this is the gotcha that every time we hear from a client who has an employee that says, I owed taxes, you didn't withhold enough. It comes down to not checking this box. But this section could be more complicated than just checking that box. If you are unmarried, so you're single, and you have two jobs, and let's say one of the jobs is, you as a independent contractor, and then you have a job as W-2 income. It comes down to the income you're receiving from both sources or two sources. If it's equal, if it's the same, so you have two jobs and you make 20,000 taxable income, taxable wage on both, then yes, you can just simply check this box. But if it's lopsided, you have one job where you make 10,000 and another one where you make 60,000. It also applies when you are filing married. If you're filing married and one person makes 40,000 and the other one makes 60, you can't simply check this box. It will get you closer. It's better than not checking it at all because you're definitely going to be short. But this checkbox is when there's two identical things. If you read through the instructions, if you do have, more lopsided, the second page, which I don't believe we have a screenshot of the W-4. Actually, it's not the second page. Sorry, it's the third page. The top of the third page is the multiple jobs worksheet. And that's where you kind of go through the computation of, all right, how much is on job 1 and how much is on job 2, or how much your spouse makes. And then the end result is they provide you with an additional amount of withholding. So instead of checking this box, you use the additional withholding amount to factor in that additional tax. For me, it's all kind of complicated. Getting your employees to fill out this schedule on the back of the W-4 form. My suggestion is use the IRS calculator that's out there. I think, Kate, on the previous slide, there's the link to it. It's irs.gov/W4 app. Don't tell your employees what to do on this form, because if it does go wrong, they're going to come back and say, you told me to do this and now I owe $5,000 in taxes. So direct them to the IRS app. They will put in their information. It's a really easy Q&A. At the end of it, the IRS prepares the W-4 for that employee to print, sign, and turn in. So so coming back to Danielle, the question, there's a lopsided on the different sources of income. So my suggestion is, even doing away with the back of the W-4, that the multiple jobs worksheet, and just using this irs.gov/W4 app, and it will put you on the right path.
Mm-hmm. Yeah, that would be pretty much my recommendation as well. Unless you have a very basic tax situation where you're not claiming anything, you have one job, go ahead and do that estimator, because that is going to ask you as well as about any credits that you're planning to claim on your taxes. Are you claiming mortgage insurance? Do you have dependents? Do you get the earned income tax credits? All of those things get taken into account on that estimator as well. Because it's always been a matter of your actual tax liability at the end of the year encompasses a lot more than just your paycheck, which is why it's hard for, us as payroll administrators to be able to tell you, what your employees should be doing, or for you guys to be able to tell your employees what they should be doing, because there's a lot to their situation that you have no knowledge of. All right. Any last questions before we wrap up?
Yeah. And again, if you came in late, we will be posting this recording out to our website in the coming days. If you registered, we'll send you an email notification of when that gets posted out there. Otherwise, it will be in our newsletter January 1st. If you do not receive our monthly newsletter with payroll information, you can sign up on PayMaster.com. Towards the bottom of the web page, there's a field to sign up for our newsletter. So with that, have a wonderful Friday, everyone, and happy holidays, and we'll see you all next year.
All right. Happy holidays, everyone.
All right. Bye-bye.